Welcome everyone to the latest edition of the JMI Wealth Monthly Update. Now, when we recorded the last video, we were eagerly anticipating two events, the Rugby World Cup and the New Zealand general election. And I suggested 4 weeks ago that by now we would be in a better position to comment on both of those, given that it's now early October as we record this, but I'm not sure that we are. The general election result, though, is still uncertain. It's not as simple to pick a winner here. Now, while a centre-right coalition outcome appears to be the pick of the polls, it certainly isn't looking sort of signed, sealed and deliver yet. And that potential centre-right coalition of National elect may also require the support of the New Zealand First Party. As I mentioned in the last video update, financial markets are normally sort of well behaved around election time. Generally, the forces driving markets won't change overnight with a change in government, but I am still a little concerned about the short-term impact of an inconclusive result. Now, looking at the broader question of the financial market landscape, over the last month, there have been significant market developments and movements. And what is dubbed the September effect was starkly evident this year. September has the distinction of being the weakest month when average US share market returns are considered. But look, with all statistical observations, there's always the tyranny of numbers, and it can all depend on the time period used. But in this case, if you look at S&P 500 returns from 1928 through to 2023, the benchmark index for US shares has had an average loss in September of 1.2%. Now, that is the worst average monthly return by some margin. In fact, there's only 3 months of the year that have negative average returns, and the other two are barely negative. For the record, the S&P 500 index fell 4.9% over the month, and in New Zealand dollar terms, those losses were accentuated due to a slightly stronger New Zealand dollar. And it wasn't just the US share market this September. The Australian share market fell 3.5% as well, and the weaker US market dragged the world benchmark index down over 4%. Now, the New Zealand share market has sort of lagged global markets all year, but it became a veritable safe haven in September. It only fell 2.2%. Now, there are a number of factors contributing to this negative sentiment, and by far the most widely discussed and noted has been a significant move higher in longer-term US interest rates. Now, you can see this really clearly when looking at the benchmark 10-year US Treasury bond. Now, it's been steadily climbing in yield over the past 4 months, but that move accelerated in September, and the yield on that bond climbed from 4.11 at the end of August to 4.57 at the end of September. Now, that's a level we haven't seen since 2007, and the yield continued to climb in the first couple of days of October. So this, I'll call it a capitulation in longer dated interest rate markets, could be interpreted, I think, as the market expressing two quite strong sentiments. Firstly, there's the realization that central banks are prepared and are currently forecasting to keep the benchmark cash rates higher for longer. And secondly, the market's now made demanding a higher risk premium for these longer dated bonds. Now, the higher for longer thesis was underlined, it was even strengthened by the recent Federal Reserve Open Market Committee meeting, which signalled that at the current point in time, the committee members now see the Fed funds rate, which is the equivalent to our OCR, about 50 basis points higher at the end of next year than they did at their last statement. Oil prices have also lifted recently. That'll potentially provide another headache for central bankers, given the likely pass-through of the higher oil price into more broad-based CPI inflation. Oil prices over the September quarter have risen about 30%, and we've seen OPEC production cuts have sort of squeezed global crude supply. Now, one feature of the strong performance of share markets that we had seen this year was the performance of that small group of mega cap stocks, now sometimes referred to as the Magnificent Seven. We're talking Apple, Microsoft, Amazon, Alphabet, Nvidia, Tesla, and Meta platforms. Now, after very strong performances so far this calendar year from some of these performances, 6 of those 7 were lower in September, and that was led by Nvidia. It was down 11.5%. Apple was off just under 9%, and Amazon was off 7.7%. The only stock in the group that was higher over the month was Meta, which gained 3%. Now, to try and give some context to these weaker share markets, in the background, central bankers are seeing inflation generally moderating across the developed world. And we had evidence of that in the US over the month. I mean, the Federal Reserve's preferred inflation gauge came in lighter than expected on a monthly basis. And we're looking at what's called core PCE, strips out volatile food and energy prices. That rose 0.1% in August and 3.9% year on year. Now, consensus expectations for that monthly outcome were actually marginally higher. Look, we're currently recommending that investment portfolios stay very close to the long-term recommended asset allocation positions. In other words, relatively neutral. Look, fixed interest returns, they're quite attractive, and higher running yields do sort of shield portfolios to some degree from capital movement volatility. So far this year, returns from diversified portfolios have been relatively robust despite that recent equity market reversal. We continue to monitor markets closely, and look, we will ensure that if we believe that some reduction in risk in your portfolio is appropriate, we will recommend that, depending on your personal circumstances and long-term objectives. And as ever, helping you achieve your long-term goals for your investments. That's something we do every day, and it's something we care greatly about. And as ever, we'd love to hear from you. We'd love to talk to you if you'd like some guidance or advice with your investment portfolio. So give us a ring or look us up. You can do that through the website, through Facebook, LinkedIn, even Instagram. And I look forward to catching up with you again next month.